Here's a question almost no investor ever asks. When a factory's production line breaks at 3 in the morning and a $2.50 bolt is the only thing standing between it and $50,000 an hour in downtime, who does the plant call, and how much do they care about the price of that bolt? The answer is nobody. Price shops a $2.50 bolt. And that single fact built one of the quietest great businesses in America. Grainger, ticker GWW, sells industrial maintenance supplies out of a catalog, and it has raised its dividend for 55 straight years and returned 571% over the last decade. Boring catalogs. Fat margins. Let's get into it. Start with the business, because it sounds dull and it absolutely is. That's the point. MRO stands for maintenance, repair, and operations, the bolts, gloves, motors, filters, and safety gear that every factory, hospital, and warehouse burns through to stay running. It's a $93 billion US market, and it's deliberately unsexy. Here's why it's a great business anyway. A typical buyer needs more than 1 million different items, available the same day, from one vendor who sends one invoice. They will pay a real premium for that convenience, because the cost of the procurement person's time, and the cost of the line being down, dwarfs the price of the part. Distributors sit in the middle of that and earn it every single day. Look at the leader. Grainger did $17.9 billion in revenue in 2025 at a 39% gross margin and a 39% return on invested capital. Read that again, 39% return on invested capital, for a company that just sells nuts and bolts. How? 2 layers. Its high-touch business embeds Grainger staff inside customer plants to manage their inventory, a program called KeepStock, so the customer literally cannot leave without ripping out their own storeroom. And its endless assortment arm, the websites Zorro and Moat, grew over 14% and now handles the commodity orders. Compete at the bottom, defend at the top. In the first quarter of 2026, Grainger grew sales over 10% and raised guidance. The boring giant is re-accelerating. Now the second compounder, and it's even stranger. Fastenal, ticker Fastenal, started as a fastener company, literally screws and bolts, and turned $8.2 billion in revenue into a 45% gross margin and a 20.2% operating margin, distribution economics that simply shouldn't exist. Its secret weapon is a vending machine. Fastenal installs over 118,000 industrial vending machines and automated bins right inside its customers' factories, dispensing gloves and drill bits 24 hours a day. It also runs roughly 2,000 on-site mini warehouses inside customer plants. Once that hardware is bolted to your factory floor, no e-commerce site on earth can dislodge it. Fastenal earns a 31% return on invested capital, banked $1.25 billion in profit, and just became one of the newest dividend aristocrats, 27 straight years of increases. Over a decade, the stock returned 395%. Its market value is now over $50 billion, for a company that sells bolts. Let's put the whole field on the board. This is a wide bench of US-listed distributors. Grainger, the high-touch giant. Fastenal, the vending platform. Wesco, electrical and data center distribution at $23 billion in sales. MSC Industrial, the metalworking specialist. Applied Industrial, power transmission and fluid power. Then the niche distributors, Watsco in air conditioning, Pool Corp in swimming pools, Core and Main in waterworks, and Site One in landscaping, each a leader in one boring corner. If you've followed this run, homebuilders, insurance brokers, and now the distributors who arm the whole economy, subscribe and stick around. Same depth, every industry. Now let's separate the great from the merely good. Here's the engine that makes these stocks compound, and it's worth slowing down on. The supplier base is insanely fragmented, roughly 500,000 MRO manufacturers worldwide. No factory wants to manage thousands of vendor relationships, so they outsource it to a distributor who consolidates everything into one account, one invoice, and one set of spend analytics. On top of that sits pricing power on the long tail. Nobody compares prices on an obscure $2 fitting they need today, so distributors quietly price those items at a healthy premium. Then add private label products at 30% below the brand names, which lifts margins further. Put it together, fragmented suppliers, captive customers, long-tail pricing, and you get a 39% return on invested capital out of a catalog. That is the whole magic trick. Now the bear case everyone raises: doesn't Amazon kill all of this? It's a fair question. Amazon business has scaled from $1 billion of merchandise in 2016 to $35 billion in 2025, growing over 20% a year in the MRO category, with 6 million corporate customers. For commodity items with a clear part number and no urgency, Amazon wins, and that's maybe 30 to 40% of the market. But for the other 60 to 70%, the technical products that need an application engineer, the emergency same-day pickup, the vending machine inside the plant, the safety-critical part that needs a traceability certificate, the incumbents still hold a structural edge Amazon can't easily copy. The threat is real at the bottom. The moat holds at the top. Here's the proof of pricing power, and it came from an unlikely place: tariffs. In 2025, the average U.S. effective tariff rate jumped to the highest level in a century. For most companies, that's a disaster. For MRO distributors, it was almost a non-event, because their pass-through rate runs near 100%. They simply raise the catalog price and the customer pays it. Watsco, the air conditioning distributor, used its pricing software to post a record 28% gross margin in 2025 even as revenue dipped. Grainger held a 39% gross margin straight through the tariff shock. When volume was soft, price did the work. That is what pricing power looks like in the real world: a cost shock that the customer, not the distributor, absorbs. Now the specialists, because each owns a boring corner outright. Watsco is the largest distributor of air conditioning equipment in North America, serving 375,000 contractors, and it's riding a multi-year replacement wave from new refrigerant rules. Pool Corp distributes everything for swimming pools. New pool construction slowed under high mortgage rates, but the 6 million existing U.S. pools still need chemicals and parts every season, non-discretionary demand that puts a floor under revenue. Core and Main sells the pipes and valves for water and sewer systems, funded directly by federal infrastructure money. And SiteOne arms the landscaping trade. Different end markets, same playbook: be the dominant distributor in a fragmented niche, then roll up the small regional players one by one. But here's the honest part: quality is not evenly spread across this group. The gap between the best and the rest is enormous. Grainger and Fastenal earn returns on invested capital around 30 to 40%. Wesco, despite a record $23.5 billion in sales, carries a heavier mix of low-margin project electrical work and a debt load from its Annixter takeover, so it earns closer to 9% on capital at a roughly 5% operating margin and a net margin under 3%, a fraction of Grainger's profitability on nearly 30% more revenue. MSC Industrial, the metalworking specialist, saw revenue actually fall and net income drop more than 20% in 2025 as factory activity contracted. So this is not a "by the whole sector" story. It's a "the moat is in the model" story. The distributors with vending machines and on-site lock-in compound. The ones reselling commodities on price do not. Same industry, very different machines. Now the risk column, honestly. First, the cycle. MRO maintenance spend is sticky, but project and capital spend is not. When manufacturing activity contracts, as it did for much of 2025 with the factory index below 50, volumes go soft. Second, Amazon, $35 billion and growing 20% a year, keeps chipping at the commodity bottom of the market. Third, tariffs cut both ways. Near total pass-through protects margins, but if it pushes industrial customers to defer spending, volume suffers. Fourth, valuation. Grainger and Fastenal trade at 25 to 30 times earnings, a premium that prices in their quality and leaves little room for a stumble. The debate isn't whether these are good businesses. The best ones clearly are. It's whether you're paying too much for boring perfection. Where does this go over the next 1 to 2 years? Base case: as the factory cycle turns back up, the manufacturing index already crossed back above 50 into expansion in early 2026, volume returns on top of the pricing that already stuck, and the best distributors re-accelerate. Probable, not guaranteed. 3 things to track. 1. The manufacturing PMI, above 50 means volume tailwind, below 50 means price is carrying the load. 2. Gross margins at Grainger and Fastenal. If they hold near 39 and 45%, the moat is intact. If they slip, Amazon is winning. 3. Reshoring capital expenditure. New U.S. factories mean new storerooms to fill, and that's the next leg up. Catalysts up, a manufacturing recovery and the reshoring wave. Catalysts down, a recession, or multiple compression on these premium stocks. Upstream sit 500,000 component makers, downstream sits every factory in America. The best businesses are often the ones nobody wants to talk about at a dinner party. A catalog of bolts and gloves doesn't sound like a 500% stock, until you see the 39% returns on capital, the 55-year dividend streak, and the vending machine no competitor can pry off the factory floor. The economy will always break down, and somebody has to sell the part that fixes it. The winners are the ones embedded so deep inside the customer that leaving is harder than staying. I'm Big Z, follow me, see you in the next deep dive.